Hey guys, it's Hamish Hodder here, and today we're going to be talking about finding out whether or not the company that you're interested in investing in has an economic moat. More specifically, we're going to be talking about what exactly is an economic moat, if you don't already know, how does it take its shape and form, and then we're going to be talking about how I identify economic moats, and then how I'm able to confirm my hypothesis as to whether or not a company has an economic moat that's strong enough to fend off its competition. If you haven't seen the first video in this playlist, go check it out, it's on my channel, and it'll basically give you a summary of what this series is going to be about and exactly what you're going to learn. It's going to be how you can invest with very little risk of losing any money at all, and I'm going to show you exactly how you can do it. Part of investing without the risk of losing any money at all is you need to pick really solid companies that are going to be solid for the next 10 or more years. And one of the key parts of that is working out whether or not the company has an economic moat. And if your company doesn't have an economic moat, it's not going to be able to survive over the next 10 years. And it's not going to be a good company to invest in if you want low risk investments. So what is an economic moat? An economic moat is the ability of a company to maintain its competitive advantage over other companies in that industry or sector. It's the ability of a company to consistently outperform other businesses even though they're selling similar products. So immediately you could jump to Pepsi versus Coke. Coke sells a hell of a lot more cola drinks than Pepsi does. And essentially what it comes down to is Coca-Cola has built over a long period of time a very strong economic moat that even though Pepsi is such a huge brand in the cola industry, and it's probably second in the cola industry, it just cannot outperform Coca-Cola when selling colas. So like Coca-Cola, many companies have an economic moat that comes in the form of a brand. However, there are many other different forms of an economic moat. Another way that a company can form a strong economic moat is they establish themselves in the industry as the industry standard. For example, Microsoft's Windows and their Office products have for a very long time, maybe becoming less relevant now, but for a very long time, the industry standard for the operating system as for Windows, and for documents, making documents and that sort of thing through Excel, Word, PowerPoint, etc. And it's very hard to come in and compete against a company that has already established an industry standard product such as Windows operating system. So what that means is that not only are they able to sell a hell of a lot of products, they're able to consistently outperform other companies doing similar products in the same space. One of the most effective economic moats, in my opinion, is when a company's name or product is beginning to be used in everyday language. I used an example of this in my last video of Google. How whenever someone's considering doing a search on the web, they say they're going to Google it. And that's really powerful when a company's name or even the product that they're selling, such as Adobe's Photoshop, is used in everyday language to describe what they're doing. There are so many different types of economic moats in many different forms. There's no way I could list them all right now. So what your job is to work out whether or not the company that you're investigating has something that its competitors don't have, an advantage that it has that it could possibly sustain its competitive advantage over a long period of time. So let's talk about the two steps that I take in order to first identify whether or not there's an economic moat and then confirm it. So first, essentially, you've got to find out whether or not you think a company has a moat. And you're going to do this by doing research on the product, seeing if they have strong market share, reading articles, this sort of thing, and you can find out pretty quickly whether or not your company has something that its competitors can't have. So then once I have sort of a hypothesis as to whether or not a company could maintain an economic moat, I want to make sure that it's evident in data. And what I do is I look at whether or not a company has really strong results over the last 10 years. Specifically, I'm looking at the sales growth, the earnings growth, the equity growth, and free cash flow growth. And I don't want these just to be growing, I want them to be growing quicker. And what I will go through with you in an upcoming video when we're doing valuation of companies is how we'll set up an Excel spreadsheet with the 10-year history, the 5-year history, and 1-year history, and we can see how the company has been growing over those years. And if it's consistent and if it's growing, then it's a pretty good indication that the company you're investing in has a strong economic moat, that its competition are not able to take them down very easily. The last thing you can look at to see if your company is maintaining its economic moat is you can look at their margins. And if their margins are constantly shrinking, it can be a sign that competition is starting to get an edge up on them, and they're starting to have to put more research and development and more resources into fending off their opponents. So you really want to see stable or growing margins. So that's it, guys. Hope you enjoyed. Leave a like if you did. Subscribe if you want to see more of this series. And of course, if you haven't seen that first video, go watch it. And if you're watching this at a later date, there may be some other videos up there that you can watch as well. So thanks for watching, guys, and I'll see you in the next one.